buyers, especially, just because we think that there is a lot of, misconception around what they can do, what they can't do. And our self-employed buyers are truly the ones that struggle the most when they're going to buy a home. So this is where we really want to focus on, excuse me, we want to focus on being able to kind of get over all the myths, get over all of the fear that they have, right? Because usually when self-employed buyers come to an agent, they might tell you, oh, someone already tried, but they couldn't help me. Or, I know that my taxes aren't look good. I'm probably going to need a co-signer. And they're kind of a little bit defeated. And so we want to kind of break that stigma and make sure that everyone knows that, hey, just because you're self-employed, just because someone else told you before that you didn't qualify, doesn't mean that that's going to be the case with us, right? So our self-employed borrowers have put a lot of work into their business, right? Building it up, whether it's a traditional brick and mortar type of business, right? Maybe they've got a restaurant or they've got an auto body shop, or maybe they just kind of do their own thing. Maybe they're a gardener, maybe they're an online person, right? They've got a TikTok account, they show people how to cook or whatever it is, right? They're doing something for themselves to try to get ahead. And so we want to make sure that we celebrate that work, all the hard work that they put into it, and help them to purchase a home, something for themselves, something for their family. So that's what these products are really doing, is giving you alternative options to home ownership for someone who's self-employed. So you may see some things here that could even help you as real estate agents, right? So our self-employed borrowers, the reason that they typically struggle is because the taxes are not reflecting what the income should be in order for them to qualify, right? And typically with a regular loan, let's just say like a Fannie Mae loan or a Freddie Mac loan, the income is going to be, very conservative. They want what we call the debt to income ratio, right? The difference between all of their monthly debt versus their income to be usually at like 43% or less. They don't want to see anything bigger than that, right? And excuse me, with us, we actually give our borrowers some more leniency. We give them something where they can actually do like real time, real world home purchases without having to say, oh, wow, you want me to not really use most of my income, right? When everyone knows that a real estate transaction or a mortgage payment is usually the bulk of your expenses. So what we've done is we've said, okay, we're not going to look at taxes. We're not going to look at the typical stuff that a buyer would give us. We're going to look at three different things, right? Whatever one works the best, whichever works the best, that's the one that we're going to lean on. So we give them the option of using bank statements where we actually look at the deposits on those bank statements, that they use for their business. Or if they happen to be a contractor, maybe like a real estate agent or like an Uber or Lyft driver, instead of the taxes, we can look at the 1099 form, right? Just the 1099 form. Or if those two options fail, then we can look at a P&L statement by itself, just the P&L statement, right? So these three things are going to be the non-traditional option. The regular option is to give us taxes, to give us what's called transcripts, which is something that comes from the IRS, and they confirm, yes, these taxes were filed, right? But that's not always going to work. So we want to offer them these three options. But we also want them to know that just because we're using these three options doesn't mean that all the other stuff that we're used to using is not going to be able to get done, right? So if you look at number two, we absolutely can still use all the other sources of income that the borrower may have. If they have other people that are on the loan with them, right? A co-signer, a spouse, someone that's going to be on the loan, yes, we can still use their income. If they've got assets, if they have, maybe they're retired, right? They get SSI and pension, and they still have a little business. If they have investment properties and they have rental income, all those other sources of income are still something that we can work with, right? And we're going to give them a higher debt ratio, right? You'll see here our debt ratio is 50%. It's not 43, which is the standard. And actually, we make exceptions to go beyond that. We make exceptions to go to 55. We're making it easier for our buyers. And even more so, we're allowing them to work in a space that's going to be more affordable, right? So that's going to be the condo space. A lot of people are scared of condos because they're like, hey, I don't even know if this condo is going to get approved. Is Fannie Mae going to like it? Are they going to go with it or not? Maybe this is a cash only type of property. So if it's a non-warrantable condo, it's okay. We can work with those, right? If it's a condo tell, if it's a 4-unit property, if it's a larger acreage property, right? 20, 30, 40, 50 acres, we can work with those, right? Or even if someone has blemished credit, even if someone doesn't have, a paper cookie cutter 800 credit score type of credit, doesn't matter. We can take scores as low as 640. If someone had a bankruptcy 2 years ago, a foreclosure 2 years ago, right? Maybe they went through a divorce, maybe they went through, sometimes people give us, their real life family history and they say, hey, you know what? Like someone in my family, I was taking care of them. They had cancer. They passed away and I couldn't make the payments. I was struggling. I wasn't even worried about the mortgage. I was worried about something else. Right? We know that people go through these things. It's absolutely common. It's something that happens in real life. So we're not going to stop the buyer from getting into a home again. If they feel, hey, you know what? I'm ready. I'm paying a lot in rent. Might as well put that towards a mortgage. I'm ready. Got my down payment. Then we're ready too. We're ready with those solutions. So if their credit is less than perfect, even if they don't have all the money themselves, right? You'll look there, number 8. We accept gift. We allow for gift. So if the buyer doesn't have all of the money themselves, it's okay, right? Someone can help them. Someone in their family can help them, give them a gift. We're perfectly fine with that. So a lot of the stuff that you see on here, excuse me, it's actually making concessions for things that may come up, right? Less than perfect credit, less than perfect income, less than perfect assets, right? You don't have all the money yourselves. A less than perfect property, because not every scenario is going to be cookie cutter. Not every scenario is going to go to Wells Fargo or Bank of America, right? You're going to have a buyer that is different. And in today's space, most of our buyers have a mix of income because you can no longer survive on one income. You need more. We have so many buyers that, and it's funny because sometimes they kind of laugh when they're going to tell you, they're like, okay, yeah, I work at, the post office. That's my regular job. But I actually have a lady and I still keep in touch with her. She's like, but I do TikTok. Like I love to clean and I show people how to clean on TikTok. And I've been doing that since COVID because, with COVID, I was all about sanitizing and stuff like that. So I have a TikTok account and I make money from there. And she thought that she couldn't qualify with that. She was like, that's just my hobby. Like, that's just what I do. But I make money from it. And that's where most of my savings is coming from to buy my home. So I told her, oh, well, like, where do you put that money? And she said, well, I get paid through PayPal. Like, that's how they send me my money. It's like a Google PayPal thing. So I was like, okay, can I see your bank statements? All right, sure. And bam, I looked at her bank statements. Man, this lady was making like $6,000 a month just from cleaning online. I'm like, wow, I really need to find a different thing that I could do online, right? Because that was something that she was just like, that's just my hobby. She didn't think of it as a real job, but she's been doing it since COVID. So absolutely, she has the tenure, she has the history on her bank statements to say, yes, let's do this. So that's what we're all about here is talking to people that are doing things on the side that they may not tell you about, but if they start giving you that story, that's where you can say, you know what? This is a perfect scenario for someone who has non-traditional stuff. And I kind of want to show you this little grid before we get into the weeds, just to show you that whether it's a first-time home buyer and they want to buy a home for themselves, right? And I'll make it just a little bit bigger. Whether they want to buy a home for themselves where they're going to live, or they just want to buy a second home, like maybe they're traveling a lot because of work, they want to buy like a second home in another city, or they want to buy a rental property, right? Doesn't necessarily matter which type of property they want to do. whatever income they have with their business, with their, the person that's going to be on the loan with them, it's something that we can do if they want to buy, right? We can do loans as big as 3.5 million, right? So, I mean, if we're in an area where it's bigger, hey, maybe we can look at exceptions, right? But our regular loan is 3.5 million. That's our max. The minimum that we're looking for is 10% down, right? So it's not going to be something like an FHA, like 3.5. But I will tell you that we don't have mortgage insurance. We don't have PMI on our loans. And if you've ever worked with anyone that's done a low down payment on Fannie Mae or FHA, you know that PMI comes with the payment. And depending on the price, that could be $200, $300, $400 sometimes. And that's something that they're not going to be able to get rid of for years to come. So we don't have that on our loans, right? But that's why we ask for a little bit more down, 10%. Which, to be quite honest, we've looked at a lot of buyers, and most of them, because of the area that they're in, they're looking to make a bigger dent anyway. They know that 3% is not going to give them a loan amount where they can actually afford that payment. So they're already ready with a little bit more money. They're getting money from their parents, their grandparents, or it's two, three people on the loan. That's something that we're used to seeing. So 10% is what we're looking for, but there's no mortgage insurance. And then credit score, you'll see there. Minimum credit score we're looking for is a 640, right? So this is all to buy a primary home. Let's just say you had someone that wanted to buy an investment home, right? That's the one on the bottom. 15% down can get them through the door with a 720 score. But even if they didn't have that score, they had a 640, they could still buy an investment property. So this is just kind of to show you that regardless of the type of property they wanted to buy, one that they're going to live in or rent out, they're able to do it with non-traditional income and with less than perfect credit. So it's not something that is out of reach for them. It's very much within the scope that they're in. Okay. So let's get into what we can actually use, right? So the most common option, the one that we see the most with our self-employed people, excuse me, is bank statements. Because most people tend to keep one, at the absolute most, two accounts for a business. And so if we're looking at those consistent deposits, then even if we're not going to look at the taxes, we can say, okay, yeah, every month there's about maybe, $3,000 to $4,000 for this little business that they're running on the side, right? So absolutely, I can do an average for 12 months and I can, say, okay, I can say from this business, you're making $4,000 a month, right? What I'm really looking for, what we're really looking for is someone that has hopefully 2 years in the business, right? If they've got 2 years in the business, and you'll see that at the very top, then definitely it's someone that is eligible right off the bat. They can do 12 months of bank statements. Sometimes they want to do 24 months. It gives them slightly better pricing. That could be like, instead of a 7%, they can get like a 6.875, something like that, right? So it'll give them slightly better pricing, not a huge deal, but something a little bit better. And all we really need is for them to be self-employed for 2 years, right? With these bank statements, yes, they can do the 10% down. They can do the $3.5 million loan. They can have a 640 score, whatever the scenario is, right? All you're going to do is, let the borrower know, hey, don't worry about your taxes. It's okay. We've got a great team that we're working with, and they're going to educate the borrower along the way and say, hey, taxes is not the only way for you to qualify. Let's look at your bank statements. So our team is going to look at their bank statements, and then we're going to do the tally and the average of what it is. We literally go through the bank account, go through all the deposits, and do an average, right, for the business. Now, if you have someone that's been in the business less than 2 years, maybe 1 year, still okay. We can still work with them, right? But we want them to have a little bit more experience in that business. So maybe someone who, let's just say someone who worked at a restaurant, maybe they were a server, they were a cook, and now they opened up their own restaurant, or maybe someone who was a hairstylist at a salon and now she opened up her own salon, right? Someone who has a little bit more experience, but maybe they don't have the 2 years experience in their own business. It's okay. because at least they have experience in the industry. So that's really what we're looking for, is just for us to know, all right, we're going to qualify you on your business, but you have experience in the business, so you're running it well and you're making a decent amount of money, right? We are going to be the ones to tally up the deposits on that account and say, okay, this is the income that we're deriving from this account, so we can qualify you on this, right? And if the borrower happens to have multiple businesses, it's absolutely fine. We can do different sources of income, right, from different businesses. If it's not a traditional business, like, a restaurant or an auto body shop or a clothing store or something like that, right? Maybe, like we said, they're on TikTok or they're on YouTube, or maybe they're an Uber driver or a Lyft driver, right? It doesn't have to be a traditional type of business, as long as we can get someone to verify for them, right? Maybe they have a business license and that's fine. And they have their operating agreement and stuff for their business, or someone, right? Whoever does their taxes, or a CPA or an accountant, someone can say, yes, I verify this person is self-employed. Then boom, we've got it made. We can do it. So it's super easy. So the bank statement option works really well for people that are like gardeners, housekeepers, nannies. They've got an actual business set up. It works really, really well for that. And even for people that are doing stuff online, right? Like YouTube and Instagram and TikTok. These platforms have blown up. So people are actually making money off of this. Okay. So this is our very first option. Our next option, excuse me, is just using the 1099 form, right? This is not the taxes. This is the form that you get from the company you're working with. And a lot of you here are real estate agents, so you probably get a 1099 form, right? You work at Keller Williams. You don't own Keller Williams. You work there, you hang your license there, you're a contractor. So, but even though you work for Keller Williams, you're considered self-employed. So a real estate agent is actually the perfect person to fit into this grid as well as someone, like we said earlier, who is an Uber or Lyft driver, who's a truck driver, who is a construction worker, right? All of these types of professions, you're considered self-employed, but you're kind of under an umbrella of a company, right? But they give you a 1099 at the end of the year. You get a kind of like a pay stub or a pay slip every time you get paid, kind of showing what you got paid, but they're not taking taxes out of your pay stub, right? You got to do your own taxes quarterly or at the end of the year. So you're considered self-employed. And this is also the type of person that we can work with, right? We can just look at that 1099 form. Let's just say you got a form that had 100,000 on it. Let's just say 100,000. We would look at that 100,000 and we're gonna take 90% of it. And that's what we're gonna use for the year. I'm gonna take that divided by 12, and now that's your income. I took 10% off the top just for like your expenses and whatever you're gonna do at the end of the year for your taxes. So I'm gonna use 90% of it. That's gonna be your income. It's as easy as that. Super easy. So we actually do get a lot of people, and I know people that do Uber, Lyft, DoorDash, people that like just drop off food, door dashing, Uber Eats, Grubhub, because everybody now has a little side hustle, right? Everyone has that side money. You kind of need it. Where are you guys? What city are you in?
We're in Beaufort. It's north of Atlanta.
Oh, okay, okay. So I don't know if it's like a really big city, if it's very expensive. I'm in Los Angeles. So just telling you that, we cannot survive here without 2 or 3 sources of income.
Wow.
There is absolutely no way. Every person that I know, friends, even like my neighbors, my front door neighbor, he does pizzas. He's a welder, and then he welded a little pizza oven thing. And he has an Instagram. It's public to everybody, and everybody's on Nextdoor, the Nextdoor app. every weekend he's making like stone fire pizzas. And he sells them to like people in the neighborhood and people come from other neighborhoods. You know, when they are not going to cook or whatever, he sells the pizzas for like $15. But he's a manager at Subway. But he doesn't earn enough for his home, like his family. So he also does pizzas on the side, right? My other next door neighbor, he has his regular job. He works at the school district. He like he kind of does like the security, like takes care of the high school, like for when there's fights and things like that. He makes pretty decent money, but he's got 4 kids, right? And his wife is a stay-at-home. So he also does Uber in the evenings. Like when he gets home, he has dinner, and then every night when we're outside, like I see him at around 7 p.m., he goes out and he goes to the airport. We have an airport nearby. So that's where he makes a good amount of money because the airport fee is pretty high. So he makes really good money. But almost everyone that I know has an extra side hustle.
Yeah, we see that a lot here too.
Yeah.
Even
But
in
you are in the second most expensive city in the nation.
Yeah, you
so
are, yeah.
Yeah.
We're not even close, but
But a
but
lot
we
of
do,
people
yeah.
have,
We do see a lot of side
Yeah.
gigs, multiple jobs.
Mhm.
I've had
Yeah.
several, 2 full-time
Yeah.
jobs.
It's almost mandatory, right? Because even if you do have an affordable home, but if you have a family or just even the rising cost of, gas, groceries, you have a family and your kids want to play sports, it's like, okay, I got to pay the registration fee. I got to buy
Right.
cleats and uniforms, and things are just like piling up, right? So a lot of people, especially since COVID, and I've noticed that that's kind of the story ever since COVID, and people, a lot of people weren't working and things like that, and people didn't want to go to the grocery store. So people started doing that, delivering groceries in their car. And they're like, I don't have to have anybody in my car. I just pick up the food and drop it off in their front door and I'm getting paid, right? And I'm just in my car on my own. So a lot of people have been doing it for like 5 years already.
Yeah.
So absolutely, if you have people that have a regular job or even this became their thing, to them, they just think, no, well, that's just kind of like my thing that I do on the side. It's not really, are you really going to be able to qualify me on that? Absolutely, we can. So it's just about changing their mindset because sometimes they're defeated, right? And sometimes they come to you like, yeah, I already been to other banks. I went to Wells, I went to Chase, I went to wherever, and they told me no. Because a traditional bank is not going to look at things the way that we are, right? These are our products, these are proprietary, and we're finding different ways to qualify the new generation of buyers. It's not the cookie cutter way anymore, right? So this is our second option, super popular option, and it's so easy. And then our third option, and this is for someone that, hey, you know what? You don't have the 1099. You do have a bank account, right? Because you run a business, but the deposits have been scarce, or and we do run into people that kind of have messy finances, and it's like they have 6 bank accounts, they deposit into every single one, they spread their money all over the place. So there's really no consistency. If that's the case, or maybe, they've been struggling through something, so they're just kind of getting back up, and we're not going to see the deposits, and it's nothing on the taxes. We have the final option of saying, okay, if you can get a CPA to write out a P&L for you and say, this is what they earn, we will take that P&L at face value. Meaning you're just going to give me one piece of paper that says from the CPA, this is what they earned in the last 12 months. These were their expenses, and this is their net profit. I'm going to take that net profit, right? Just like I took the 1099, I'm going to take that net profit, whatever it was, just divide it by 12. All right, that's my income, right? But it has to be signed by a CPA. And that's all stuff that we'll talk to the buyer about, right? But even when there's no deposits, the taxes don't look good, there's no 1099, even when that happens, we still have an option for that self-employed person, right? The P&L. It's going to be a little bit more conservative. So it's not going to be 10% down. It's going to be 25% down on this one. However, you're still giving them an option, right? When there was nothing else in place, when there was absolutely nothing else that you could do. So it's still helping them to get something done. And if we can keep the loan at $1 million or less, I mean, we are literally just looking at a P&L, meaning that they don't have to turn in anything else. All right,
Well,
so
that's
this
good.
is becoming a very popular option. I like the bank statement one personally, just because I can actually see something tangible. I see the deposits, but if this doesn't work, then we've got 1099 and we've got P&L.
Cecilia, is the bank statement of those three the most popular probably?
Yes,
When you see the most, okay.
yes, the bank statement is the most popular one because mostly everyone does deposit their stuff for their business, right? But in the case that you run into someone that doesn't, you have the other options.
Right. With the bank statement, what deposits can you not count? Are there some?
So we don't have a list of what we can't count.
Okay, okay.
What we do is we just look at it very common sense, right? So if you give me someone who's a hairstylist, right? She's got her own salon. I am going to expect to see a lot of cash, maybe
Right.
personal checks, credit card transactions as deposits. But if in that salon, bank account, I suddenly see a $15,000 deposit, I'm probably going to say, is this from your business or is this something else, right? But the same goes with if I have someone who is, a realtor, right? Like yourselves, and then that realtor has big deposits, 7, 10, 15, 20,000, I'm not going to question that because that's typical for an agent. But if you have a lot of cash deposits, well, I know real estate agents don't get paid in cash, so I'm not going to use those, right? It just
Right.
kind of really depends on their profession and the trend, what's typical for that type of business.
Consistency of the deposits. I've noticed that two of the ones I can think of that they don't include is obviously like a refund. If there's a refund, they exclude that. Cash back, credit card rewards, they exclude
Yeah.
stuff like that, where it's like very, those things are a little more obvious, where it's clear it's not from their business.
Yeah.
But yeah.
Exactly. So, before we pause on this one and move on to another product, does anyone have any questions or maybe anything that like I wasn't too clear about that. Anything that I could kind of clarify for you on how to work with a self-employed buyer?
Yes, like to have a question.
Sure.
About the last part, 25% down payment
For the profit and loss?
for P&L.
Uh-huh.
Mhm.
Apply for everywhere, every state in the country, or
It's open to all states, right, Cecilia?
Oh, yes, these products are for all states, all 50 states.
Nationwide. All of them.
nationwide?
All of them are nationwide.
Yes. Yeah, all of our products are nationwide.
Thank you.
Sure, absolutely, no problem. Yeah, so a lot of times we get people that, they want to buy an investment property, but not in the state they live in, right? They want to buy it in Ohio or Indiana, wherever. Yes, we can do loans in all 50 states. Mhm.
Y'all have any other questions?
Guys, it's really unique to have these products, I mean.
Yeah.
Sure. Yeah.
And we're one of the only lenders that we don't broker it out.
Right.
So it stays with us. So we know everything that's going on. We have Celia. She's fantastic. He
Yes.
responds very quickly. Anytime you have a question, and that's a big deal too, is some lenders have the product, but it's not their, excuse me, it's not their product. So they're brokering it out, which if you don't know what that means, it means they're sending it to some other lender. They're not really, so then you're dealing with delays and it's not as streamlined and all that kind of stuff.
You lose a little bit of control.
You lose control. You don't have control over it. Yeah. So.
And New Res, did you explain that? New Res is our corporate offices. So. Okay.
Yes.
So you got it.
Yes.
Okay.
So the other product that I want to share with you is our investor product. Now, this one is also so popular because now we have a whole new generation of, just even regular families that are saying, okay, we've got to do something because our kids and our grandkids are not going to be able to buy a home in 10 or 15 years, right? So we've got to do something, we've got to help them. And there's a lot of conversation about generational wealth, and people that wouldn't normally look to invest are now saying, I need to invest, right? Not necessarily do I want to be a landlord, but you know what? The times are tough and I've got to get in the game. So investing is no longer just for a real estate mogul. Investing is open to everyone. And we've got a great product that we call DSCR. And what DSCR means is debt service coverage ratio. And you're going to love this. You're going to love it for yourself as a real estate agent because you can actually buy an investment property without using income to qualify. You're not going to give us any taxes. You're not going to give us pay stubs, W-2s, P&Ls, 1099s, SSI letters, award letters, anything that you would normally say to your buyer, you got to give me pay stubs and W-2s. You're not going to do that, right? What this deal does is that it says, okay, you're buying an investment property. Okay, well, you're going to have a tenant there, right? Okay, so let's see what kind of rent you can get, and we're going to qualify you on that rent. If you can make enough rent to pay the mortgage, you've got a deal. That's basically it. We want to know if that property is going to be self-sufficient. Can it pay for itself? And that is the entire basis of this loan. So can you imagine buying a property? Yes, you're going to do your down payment, but buying a property and not worrying about whether or not your income is good enough or is going to qualify, or if you need a cosigner. You're not going to need a cosigner. You're not going to have to ever provide any income. We don't use that to qualify. We're not really qualifying the buyer. I mean, we want to see a good credit score, but we're qualifying the property. Is this property going to be a good investment, right? So this is called DSCR.
Before you move on, I have a question on that other slide.
Sure.
That 1.25%, that is basically the requirement like of the, when you divide the monthly rental income and the monthly payment, do you have to be making that 125%?
No, that's just an example. That's just an example. But you could be breaking even, right? So let's just say that you're collecting $2,400 in rent and your mortgage payment is also $2,400. You're breaking even. You take the rent divided by the mortgage, you're breaking even. Absolutely fine with us. Even if you're paying you're collecting $2,400 in rent, but your mortgage payment is actually $3,000, we're still okay with that. We're still okay even if you're upside down, right? This is just an example of, you know, most people are looking to make profit, right? Looking to cash flow. But whether you cash flow, whether you break even, or whether you're coming out of pocket every month, it's still a deal that we can do.
Okay.
Okay, so, and we're going to go over how all of that's going to work. So first of all, and I'm going to make this a little bit larger so we can just kind of focus on these things right here first. First of all, who can do an investment property, right? I think probably as agents, you know that a first-time home buyer cannot purchase an investment property. First-time home buyers are usually, we guide them towards buying a primary home first, right? One that they're going to live in. So, excuse me, the people that we're looking for here are people who are already homeowners, whether it's a home that they live in or they already have an investment property, right? But first-time home buyers, we're looking to like, hey, the first home that you buy should be one that you're going to live in, right? So really you're going to look for someone who already owns a property, whether they own a bunch of investments or they don't own any, they just own their primary home that they live in. Either one is fine. Because these people are going to qualify without income, we are looking for slightly higher credit scores. So instead of a 640, like the people that are using bank statements, we're looking for a 660 or 680. And it really just depends on whether you own investment properties or you don't, right? If you do own investment properties, we cut you a break. Even if you just own one, you can go to a 660. If you don't, you only own the home you live in, then you need a 680. Right? So just slightly higher credit, but it's not even a 700 still, right? Once we determine like, okay, where are you credit wise? This loan is so simple, it's going to blow your mind. The only thing we care about is how much rent can we get for this property? That's it. So you'll see once we look at the scores, the next thing is how are we going to qualify you, right? Are we gonna get long-term rents or are we gonna get short-term rents? And what that really means is a long-term rent is when, let's just say we're in a suburb maybe, where it's just regular families living there, they're renting, they're gonna be tenants there for a year, 2 or 3, right? And they actually have a lease, but they're the ones living there. Or if you're in an area where it's more, people go there for getaways, you're by the beach, you're by a lake, you're in the mountains, excuse me, then maybe that property is geared more towards weekend type of rental, like Airbnb or Verbo, right? Which are the platforms that people use to rent out their properties. So for us, it doesn't really matter which one we use to qualify you. If you're in an area where regular tenants and regular leases are the thing, by all means, let's qualify you on that. If you're in an area, you're by the beach, you're by a resort area, you're by Disneyland, and so people want to rent out your house to go for the weekend, then that's what we're going to qualify you on, right? So it could be short-term rents where we're looking at guests. Either one is fine, right? So the difference is, if we qualify you on a traditional type of rent where you have a tenant, all you need is 15% down. We will finance 85% of that purchase. So all you need is 15% down, okay? If you're going to qualify off of Airbnb type of rents, then you need 20% down. We'll finance 80% of it. Okay. So it's not that big of a difference because usually investors know that they need at least 20% down. That's the typical with a traditional loan with a bank. 20% is kind of like that number that's always floating out there. So they're usually ready with that anyhow. And we can qualify them on either type of rent. Now you'll see here, if you do 15%, all we want to do is see that you can break even on that payment. Meaning you're going to rent the property for $2,500 and your mortgage is not more than $2,500. You're going to at least break even, right? We never ask you to make profit. If you make profit, that's extra, right? That's the gravy on top. But we actually, let's just say for whatever reason, the rents in that area are coming out super low. And we'll go into who's going to determine that, right? But they're coming out super low. We will allow you to go down to 0.5. What that means is, let's just say you're collecting $2,500 in rent, but your mortgage payment is actually $5,000. You're only collecting half. You're literally at half. We will still allow for you to go that low. But of course, you need a bigger down payment, right? You need 25%. Or if you're going to use Airbnb, you need 30%. We never see people go that low, but we have it just in case. Just in case, right? Just in case that's ever the scenario. But usually people are somewhere around the 1% where they're breaking even, or maybe a little bit under, like 0.9, 0.8. We're okay with that because we know that this is like a starting off point. You're going to negotiate with the tenant, or in a year, you're going to increase the rent 3% or whatever it is, right? So you're going to be okay. You're going to recoup your money, right? And the loan that we're giving you is a 30-year loan. It's going to be fixed, or it's going to be an interest-only loan where you're getting a super low payment for 10 years. Like, there's a lot of things that we can offer. And what determines what the rent is the appraisal, right? If we're going to do a tenant-based type of rent where it's long-term, when we do the appraisal and we're looking at the evaluation to see what the property's worth, the inspector's also going to do a comparison of the rents in the area. And they're going to give us what's called a 1007 form, which is a rental comparison. And they're going to say, hey, look, I looked up all the rents in the area for a property of this size, four bedrooms, 2 baths. This is what it's renting out for. And they're going to actually give you a number. And we can qualify them on that.
That.
I'm sorry?
I have a question.
Sure.
On that appraisal. How about if, because currently, and I talked to Joy about this investor that's trying to buy a property. This property has 3 rent income, so it has 3 different places that they're renting. When you're trying to qualify her, what would you need, like the rental history that the listing agent, will provide eventually if we ask for it? Or you would have to wait till that appraisal is done?
So when you're buying a property, we don't necessarily take the seller's history unless the tenants are gonna stay there. But sometimes when the seller is, getting rid of that property, they may have already told the tenants, hey, I'm selling, you guys have to move. So if they're gonna move, then we're just gonna do a whole new report. The appraiser's gonna give us a whole new report, and we're gonna go based off of that. If the tenants are gonna stay, then we can go based off of what those tenants are paying.
And I think in her case, they
Yeah,
are staying.
they're
right?
staying.
Yeah.
Yeah, if they're staying, then absolutely we can qualify off of what they're paying.
Okay.
And then, of course, it would be up to you as the real estate agent to guide the buyer to say, okay, you're gonna re-sign leases with these people that are now under your name, right? Yeah, but yeah, if the tenants are staying, we can qualify off of what they're gonna be paying.
That's a good question, then.
Yes, definitely. And sometimes, we have people that were renting out, like the sellers renting out to friends or people that they know. And they're renting out the home for a lot less than what they could get for it, right? So in that case, we definitely say, hey, we don't want to say that the tenants are going to stay, or we want to make sure that we can get the highest rent for this property, right? So that we want to make sure that we let the tenant know you were paying a much lower rent to the previous seller, but now that our buyer's coming in, they're going to charge you a little bit more. And so we also want to make sure that we kind of cover for that and let not just our buyer who we're working with, but the tenants who are living there, because they also have rights, right? We want to make sure that they know, hey, if you're going to stay here, your rent's going to go up, but you also have the option to move or look for another place or whatever, right? So all of those things also go into effect. It doesn't go in deep, like we don't need to see, hey, did the tenant find another property already or whatever? As long as we have something that says we've already told them that they got to move or that they are going to pay higher rent, then we're okay with it. We don't need to know like their whole life story, where they're going to go or anything. Yeah, but really this type of loan makes it so easy for anyone to buy an investment property and not worry about if they need a cosigner, if they need income. We're not going to use any of your income. The way we qualify you is based on the potential rent for this property. So the nicer it is, the better area it is, the more rent you're going to be able to get, right? So it just kind of, we're giving you the options of a traditional type of lease or even Airbnb type of lease, right? Or type of rent. Both can work, and it's just really depending on the area, what's more prevalent, right? And you're still going to be able to do what you'll see here on the right-hand side. Let me just make it a little bit bigger. You're still going to be able to do the more difficult properties that people think of, right? Like condos and condotels, 4 units, like you mentioned. With this type of loan also, if people want to close in an LLC, like they say, well, it's going to be an investment property, so I want to protect, my asset. I want to use my LLC to do this. I don't want to put it in my name. It's absolutely fine. We can do that. We can do, even if they don't have all the money for the down payment and they have a family member that's going to help them with the down payment, absolutely fine. They can get a gift, right? It's not something that we're going to say, oh, nope, sorry, right? The main thing that we're focused on is that they're going to cash flow eventually. Even if they're not cash flowing right now, eventually they will, right? Because they're going to, increase the lease in 2 years or in 3 years, or maybe they'll refinance later once they've gained some equity and, lower the rate, things like that, right? But what the whole purpose or the whole gist of this type of a loan, excuse me, is that the borrower's not going to live there. They're going to have a tenant who's there, and that tenant is helping to facilitate the turnover, the cash flow on this property, because they're paying you rent, right? And in the beginning, you're going to collect a security deposit first and last. So you're already covered there for a little bit, right? That's the whole point of this type of a loan. And that's why it makes it so easy to buy an investment property, even easier than to buy a property that you're going to live in. Because you don't have to qualify with income. There's no debt ratio, there's no cosigner, there's none of that. And these loans actually close faster than traditional loans. These loans usually close in 2 to 3 weeks because there's really not much for us to verify. Yes, we're looking at your score.
A lot of documentation, yeah, which is
Yeah.
great.
There's
One thing I was gonna point out, Celia, the part, and I'm glad you put this on here, the LLC vesting, that is very unique. Normal programs, you cannot buy it in an LLC name. So if you're an investor and you want to buy a property in your LLC, you would have to do the mortgage. Then afterwards or whatever, get the deed transferred into your LLC. This is a very unique program because it allows you to buy it in your LLC name, which is huge. A lot of my investors love that, being able to put it in their LLC name. So I just wanted to point that out.
Now, with this, what are the interest rates that's running on
So
long
I
term?
actually just looked at a scenario yesterday for a client that's buying an investment property, and I was looking at all the different options, a standard conventional versus this one. This one was a better rate. And also keep in mind, with the 15% down, there is no PMI
Right.
still. With a
So even
conventional,
if the
you
rate's a
do.
little bit higher.
So the payment was about $200 more if he had stuck with a conventional loan, which was very interesting to me. Because Celia, we've been making some great rate reductions on these.
Oh, yes. Yeah. We're super competitive on this product because there's just so many investors out there that want to get their hands on properties. Excuse me. Actually, just last week we hosted a webinar and we pulled a lot of data, right, from real estate offices and things like that throughout the year. And what we noticed is that about a third of all buyers are now investors. They're not buying the home for them to live in, they're buying the home to rent out.
A third, that's a
So
lot,
this,
right?
yeah, a third is a lot. This product is becoming like the new go-to, right? And because it's easy to qualify in the sense that you don't have to provide your income, people are like, hey, you know what? Even if I'm not gonna live in it, or I'm gonna live with my family, whatever, I'm gonna buy an investment property because I still can earn the equity. Even if I'm not cash flowing and I'm breaking even, I'm earning equity and eventually I'll cash flow, right? Certain areas like, certain states are much, much less expensive, so you can cash flow. But regardless of where you're buying, you're building equity no matter what. So people are really looking at this as the way to go because real estate is always going to be something that people strive for. It's the American dream, right? You want to own your home. So whether it's people that are buying their second home and investment, it's always something that is there. And now with the possibility of qualifying with less documentation and so much faster, people are really using this product so much more.
Does this loan have a prepayment penalty for those investors?
I'm glad you asked that. That's a good question.
Yeah.
Were
It
you
has
gonna
options
slide
for
on that?
prepayment penalty. It has options. So it's not a mandatory. You can absolutely say, no, I don't want to prepay. I'm going to, pay off this loan in 6 months or a year. Or you can say, no, you know what? I think I'm going to keep this property for, 2-3 years and we can give you a prepay. And all that really means is you're not going to refinance or sell the property within that time frame. And if you can do that, then we can offer you a much better rate. And it could
Yeah,
be
so
the
it's-
difference. Yeah, it could be like 1/4 to 0.5% rate difference. So
And it's
I
their
usually-
option.
Yeah,
So
and it's
let's
optional.
see if I understood. So if the investor says, oh no, I'm keeping this for at least 2 years, 3 years, then you'll put that in there and what would be, it'll affect the interest?
It affects interest rate, right? So the standard is 3 years. That's gonna give you the best interest rate possible is the standard 3 years. Then you can go to 2 years, which is slightly higher rate, and then a 1 year, which is higher. And a 0, you can even do a 0. Because I did this yesterday too with I was explaining to him. So it was interesting. From the 3 year down to the 2 year was only a 0.125 difference in the rate. However, further down than that was 0.25 or 0.375.
It's really about the rate.
It's all about the rate. So it's like if you want the best rate, you do the 3 year, but you do have the option, which I like that about this program is you do have that option. It's your choice.
And investors, they're used to like prepayment, that's,
Yeah.
they just know that's part of it.
Cause
Yeah.
Ask about
investors
it,
are buying it long, like
Yeah.
they're not planning on selling
Yeah,
it or anything.
But they
anytime
like to
soon.
know what are the options, cause they don't like
Of
being
course.
binded to like some company lenders be like, nope, 5 years, this, that,
Yeah.
you know, they wanna have that option.
Exactly.
That control of saying
Yeah.
2 years or nope, I'll keep it for 10 years, you know?
Yes.
Yeah,
So, that's why I was asking.
yeah, this is the only product we have that has the prepayment penalty, but I love that it's optional. It's still not required or forced.
It's not required, exactly. And with our first timers, like the people that are buying their very first investment property, they're usually like a little bit fearful, like, oh my goodness, they're nervous, right? I'm buying my first investment. I hope it goes well. So more than likely, they're not going to sell or refinance in those first 2, 3 years. So we usually say, hey, we want to get you the lowest payment possible so you can actually cash flow. So if you can keep this for at least 2, 3 years, we'll get you the best price. And we do usually offer them a 2 or 3 year prepayment penalty, right? With people that are like flippers, excuse me, and we ask them, right? Are you going to flip this property? Because if you are, then yeah, don't take the prepay because there's no point in you paying a fee later if you know in 6 months you're going to flip this property. But a lot of times they're like, no, this one, I like it. It's in a good area. I'm going to do Airbnb. I'm going to keep it for a while. But those are questions that we'll ask. And of course, it's all optional. But if we can determine that they're probably going to keep it for a while, we'll do the prepay so that they can take advantage of the lower payment. All right. Now with this, remember, we're going to have US citizens and permanent residents. We treat them the same. So our permanent resident, remember, they're going to have a green card. We treat them the same and they're eligible here. If you have a work permit only, which you're not a non-permanent resident, unfortunately, you're not eligible to purchase an investment property. You can only purchase a primary home that you're going to live in. So that's kind of like the little thing to look out for. Investors, they've got to be permanent residents or US citizens, okay? However, we do allow for foreign nationals to purchase investment properties. So what does that mean? So a foreign national, excuse me, is someone that actually doesn't live here in the United States. They live in their own country. They're not a citizen or a resident here. They are a citizen and resident of their own country. So a big example of that is Canadians. We get a lot of Canadians that have family in the northern states. They visit a lot. It's very easy for them to cross the border, right? Visit friends and family. And then eventually they say, well, I want to buy a property here too, right? I come here all the time. I want to buy an investment property. We can do that for Canadians. And we do it through this product because we don't have to use their income, right? Because it's not US income, it's Canadian income. So we're not going to use their income, but we can qualify them on the rents. However, they need 30% down. They can't do 15. They need 30% down. We can do up to $1 million loan. And even though they're not citizens or residents, we call them a foreign national as long as they have a passport and there's nothing like criminal record or anything that's going to pop up on their passport, then absolutely fine. They can purchase an investment property. And we do get a good amount of, we get people from different countries. We get a lot of people like from London and Spain as well. But I would say Canada is our number one. Excuse me. And again, that's just because, they're our neighbor to the north. So a lot of people, travel consistently to see friends and family. So if you happen to have international contacts, then just know that this is also a product that you can use for anyone that may want to purchase an investment property. You can also work with a foreign national.
They cannot close on a LLC. It has to be under their name.
Yes. Yes. Yeah.
Because they're registered in.
And then you said it's at 30% down.
Right.
And it's 30% down. Yes. 30% down.
When you mean valid passport, you mean like their country passport?
Yes, their country passport. Yeah. Yeah, they're not going to have it like a US visa or anything because they're a citizen and resident of their country. So as long as they have a passport, a valid passport, then we're okay with that. And it's going to be their country passport. So this is just another type of borrower. It just kind of opens the door, right? Because sometimes you do have people that tell you, oh, I have, a family member and such, and they wanted to buy, like, do you think that you could help them? So if that is ever the case, then it's something that, yes, you absolutely can do through this program through Foreign National.
Can I have a question?
Sure.
Any difference for this type of people about loan rate, interest rate?
A low rate? No, for foreign nationals, and I'll be very honest, the rate is actually a little bit higher than our citizens or residents here. It's going to be a little bit higher, you know, just because there's always that likelihood that, you know, if they don't get a tenant or they just don't keep up the property, they can just skip out, right? Because
Riskier.
yeah, it's riskier. They don't live here. There's no way for us to really kind of go after them if they don't pay. You know, they can just say, oh, whatever, it's in another country. No one's ever going to find me.
Yeah.
So it's because of that risk, that's why the rate's going to be a little bit higher.
Can you give us just one the number like the rate? For
Right.
example,
I can give you a ballpark. So let's just say a regular buyer here, a citizen or a resident, let's just give it out there, like would get a 7% rate. A foreign national would get maybe like an 8.5 or a 9%.
Thank you.
Sure. All right. So any other questions? And again, today we did our self-employed buyers and our investors. These are the two biggest scenarios that we get on a daily basis from buyers. People that are struggling to get traditional financing, right? It's going to be someone that's an investor or someone that's self-employed. So it's really good for you to know that there's options out there for them. There's not, you know, there's no need to close the door on that or say, oh, no, this deal's going to be way too hard. I don't want to stress myself out. We've got great experts here with our team. So definitely bring them over and let's see what we can do.
Yes, we appreciate you.
I
Yes,
have a
thank you so
question
much.
before we
Yeah.
leave. Cecilia, I have a question. For somebody, and this is a personal question, like I am trying to refinance one of my rental properties, to take it out of my name because, as a real estate, I can have, you know, several properties. Will the SCR loan, benefit me? And
So
putting my property in an LLC, no cash out or anything, just kind of transferring it into my LLC. And right now it has just a regular mortgage, a conventional mortgage. So I would change it to a DSCR,
DSCR.
right? And make it a LLC, so that it can be out of my name, out of my, you know, social, because as a real estate agent, I can have more than like one. So would that, you know, would that be helpful?
Yes, absolutely.
Okay.
Absolutely. And it'll be so much easier because you don't have to provide any of your income to us.
Yeah.
So
Okay.
all you would do, since you're going to refinance that, is give our team, you know, your mortgage statement so we can order the payoff, see what the balance is going to be. Obviously, whatever your taxes and insurance are for the property, your homeowner's insurance, and then give us the lease that you currently have on the property with your tenants. And then, of course, we're going to order an appraisal to make sure that the value is there for the property. And then they're going to confirm, hey, yeah, this is what you can get in rent in the area, right? And
Okay.
we'll qualify you on that. Hopefully we can, you know, lower your payment, take you out of your name, put you in your LLC.
Yeah.
Yes, absolutely.
Okay, yeah, sounds good.
All right. Any other questions out there that we can help you with? Looks like we're good.
Thank you.
Thank you so much
We're
again.
recording it, so we're gonna pass it along to the market center here, so that'll be good information for them.
Yes, yes, absolutely, absolutely. Well, thank you all so much. I appreciate you guys having me. And of course, anything you need, just reach out. Thank you so much.
Thank you. Have a good rest of your day.
You too. Take care.
Bye-bye.